Hello everyone, and welcome to another episode of the Business Growth Show, where we talk about all components of business and how to utilize them for exponential growth. My name is Athin Cassiotis. I'm a serial entrepreneur, international speaker, results strategist, business coach, mentor, and consultant. After over 14 years of being in business and running multiple companies, I felt called to start this show. I see many people struggling to start or grow a business, which is why I want to help entrepreneurs achieve success in business quicker, more effectively, and sustainably. Today, I have an awesome guest. She is a buy and sell advisor, capital raiser, international speaker, coach, mentor, SheEO Activator, and capital raising show host. If you're looking at growing and selling your business, then you're in the right place. She provides extensive experience in a variety of business situations to ensure you get the best outcome. Welcome, Cissy Ma, and thank you for being on my show.
Thank you, Athin. Thank you very much for the invite. Love to be on the show.
Yeah, awesome. It's awesome to have you here. I'm sure it's going to be amazing for all of our listeners. So, you're a very successful entrepreneur. So for those people who don't know who you are, please introduce yourself by telling us a bit more about you and your journey.
Sure. Thanks. So I started the journey in the mergers and acquisition field, I guess about 26 years ago. So basically, in Australia, started working in really large corporations, doing mergers and acquisitions, buying and selling large businesses. So I did about $17 billion of transactions during that period. So then I realized that a lot of the potential clients that came to me for help, because their sizes, they are around, maybe $2-3 million per annum in revenue or up to $10 million in revenue. The company I was working for basically had a threshold that if you're not $10 million of revenue, we can't help you. So I feel like there's we would say about 97% of Australian businesses, or even higher percentages, are small and medium businesses. So I couldn't really help a lot of people that came to help me. So I decided to pretty much, start a business that sort of work in the same field as I was doing the, really large transactions, but working to help, small and medium businesses, businesses that could be running under $10 million of revenue per annum, for example. And they are looking for help to grow their businesses faster, on the, we call the J curve. Sorry, this way, going the wrong way, always going the wrong. Yes, so, they need a bit of help, either from external investors or partners to pretty much, catapult their business into a really great growth trajectory. And some businesses are, business owner who's been working in the business for a very long time and looking to say, yes, maybe it's time for me to move on and, for somebody else to take over the business. And that's where I come in as well. And sometimes I do also help large businesses like listed, I've got New York Stock Exchange listed company, I've got Hong Kong Stock Exchange listed companies, etc., and NASX listed companies that are looking to acquire smaller businesses to, basically they call it inorganic growth, to help them, expand a lot quicker. And so I help those businesses as well. So I'm kind of I call them the Business Grow and Sell Your Biz, a one-stop shop to grow and sell your business.
Yeah, awesome. That's some amazing experience that you have, and a variety of things. And I love that you're helping the smaller and medium businesses, because like you said, that's the majority percentage wise of those businesses. And you also have a lot of connections in all the continents basically, and obviously you're originating from China as well, so you're very connected there too. So how does that work in terms of the businesses that you're focusing on more on, and what are you sort of providing in those spaces?
Yeah, I do have a lot of Australian businesses looking to expand overseas, for example, whether they want to expand to the US, to China, to Asia, or to Europe, I have connections in those areas, so I can actually help them expand by, sometimes it's getting the right investors or partners, because wherever you go internationally, the hardest thing is to actually understand the local culture, the local business etiquette, the local legislation, all of those things, tax structures and things like that. So if by having a local partner, you basically saving at least half of the hassle, but you go at least twice as far with a local partner. So that's how I help Australian businesses to go overseas. And vice versa, there are overseas businesses that are looking to expand in Australia. For example, the ones that I was talking about, the Hong Kong Stock Exchange listed, the New York Stock Exchange listed companies. They see Australia as a destination of investment that they want to grow here. There are certain, Australia is pretty good at a number of areas, like mining industry, for example. Australia is pretty good at some of the, I guess, the health, research and things like that. So there are overseas partners who would want to partner with Australian businesses to grow that way as well. So it's a two-way street. And sometimes you could be looking at a business that are in a number of jurisdictions, and that's when there's some maybe complex tax issues that you've got to be aware of, that you're going to be able to help people. So that's where my CPA training comes in handy as well. I'm a fellow of the Certified Practicing Accountants of Australia, and I think we have 165,000 members across 200 countries. So it makes it easy when we want to, try and reach out to people as well. Yeah.
Yeah, that's amazing. And obviously, you're based in Brisbane, and being able to help businesses, and especially in these times where, a lot more global things are happening and people wanting to go into different markets. So it's really imperative that people look at, who can help them to do that, because like you said, there's so many differences in these countries and tax structures, and with your CPA and your contacts around the place, then, because if you don't structure your business correctly or the deal correctly, then, you could have big implications down like that as well. So
right. Local tax issues that could actually even kill a deal, or if there are things that specifically for overseas investors, you got to look out for those things as well. Some countries are not that welcoming of overseas investments, and others are different. So so it's always important to actually research and understand the local laws before you decide to expand. Yeah. Mm-hmm.
Yeah, that's awesome. So in terms of the main, I guess, considerations to focus on, to get the highest business valuation, what are your thoughts on that?
Well, it depends on what sort of business. So if we're talking about technology-related business, with what we call them recurring revenue, that's what people love the most, because recurring revenue means that you can get a lot higher multiples on either revenue or EBITDA, which is earnings before interest, tax, and depreciation and amortization. It's a bit of a mouthful, but it's a pretty normal or usual factor to consider in doing, buying and selling businesses. A lot of businesses work on EBITDA, and which is kind of similar to what cash is, and some other businesses like technology-related businesses, some of them are actually done on revenue multiples rather than EBITDA multiples, mainly because they are not in revenue as yet. A lot of the venture investments, early stage venture investments, typically invest at a stage where they have very little. They have some revenue, but they're not in profit, because it takes a lot of money to actually develop a product or develop a technology to a stage where they can, roll it out to people so that they can start earning revenue. And so at the early stage, investors would invest in a business, the likes of Uber, for example, they're still not returning a profit, but, the valuation is it's still quite high. Factors to consider a lot to do with how your revenue is derived. So, for example, consultant revenue is not considered very high on the the pecking order in terms of valuation. So it's mainly because consulting revenue tend to be one-off project-related revenue. And when you try to, either get people to invest in the business or try to sell a business, the investor or the buyer needs to ensure that whatever historical revenue you're earning is a good indication of what future revenue might be. For consulting revenue, it's hard. Because once the people you might ABC or Joe Bloke Pty Ltd, Joe Bloke Consulting Pty Ltd, for example, if Joe Bloke is gone, the consulting revenue may not be there anymore. So therefore, you can't how do you value? Assuming the future revenue will be the same as past, it would be a big ask if you don't have the right revenue structure, right type of revenues. Yeah. So.
Yeah, that's some awesome points that you raised there. And I was actually going to bring up consulting, so you beat me to it, which is awesome. And I had those struggles initially in my consulting business, and it's not just from a valuation point of view; it's also a cash flow point of view. If you're just getting one-off projects, and especially when you're starting out, it's a challenge for people. Right. And you need to work out, okay, what can I do ongoing for people that people need in whatever niche that you're working in that, can provide a lot of value and then, give you that constant cash flow. And then once you crack that code, so to speak, in your space, then that's really the focus area. And, it's been, definitely, a game changer for myself to grow. And then like every sort of project you get from there is sort of like cream in a way. Where that allows you to just build more, grow, and at least you can have your expenses, your ongoing stuff, whether it's your wages or anything else that you've got to pay. Then at least that covers those areas, and then you can continue to work on those deals or any other deals, I guess that you're working on. So it's it's very interesting on the different models of how it works. And it's interesting to see I think the good part about consulting or coaching or things like that is that it's a business that is easy to get into with minimal amounts of capital, right?
Very low threshold, entry threshold. But it's also a con in that because it's so low in entry level, then anyone can get into it. Anyone could call themselves a coach or a consultant. it's who can your client or potential client or customer base, whether they believe your story or not, right? And whether you can provide the value that they're expecting. And, in terms of the consulting, you can actually work out a model that will give you a recurring revenue as well. Like, for example, what JT is doing with, Millionaire Flix. It's pretty much recurring revenue, right? $20 per month. It's a small amount to pay per month. But if you continue, a lot of people get onto something and they get into the habit of not actually unsubscribe, for example. So they'll continue subscribing to it, and so you have you have a history of recurring revenue, and in that case, when the business when you're ready to sell that kind of business, and then you can command a lot higher multiple in terms of revenue than if you were selling a business that has project-based consulting, once-off type of revenue. And even if you might have a a client that has been using you for a very long time, even for 10 years, you still can't guarantee that for the next year, they're still going to use it, right? Yeah, so that's right.
Yeah. That's that's some awesome points there. And definitely people to think a bit outside the box about, it might not be what you're currently doing. It's like, how can I change it? And I guess, there's other ways, right? So some people, want to grow their business. However, they don't want to give away equity in their business, right? Where possible. Obviously, tech companies want to give away more, need it most of the time because of how much capital. But other people in standard businesses don't, but they want to grow, right? So another avenue is like, partnering with somebody in a different context, like a joint venture or a profit share agreement or something like that, I guess. So, what are key things you think people should think about that would be fair for all of the parties if they wanted to grow a business, in a way that everybody benefits like that?
Yeah, most definitely. I always say that, it's better to have a bigger pie, a smaller piece of a bigger pie than to have a bigger piece of a smaller pie, right? So that is the thing that you want to partner with, a lot more people than you normally would do. I guess as many as possible, if you enter into sort of a formal type partnership arrangements with others, to basically agree up front to say, if we work together, then we're going to, as you were saying, revenue share or profit share or whatever that arrangement is. With, deals that I take on, if you can, get the revenue or get investors, whatever, then the fee that we will share the fee or we will share the profit out of it. And in that kind of arrangement, everyone wins because everyone wants to get, more benefit out of a particular deal. And then you also have additional people work for you pretty much, right? Other people that has aligned interests with you and who go out and do business development for you because, they want the same type of outcome as you. You might not be able to share revenue 50-50 or, depending on what sort of cost structure you have, you might have to share it, more to yourself, less to others. But the other side is true as well. If it's a deal that they might have higher, overhead or whatever, then you get a smaller share of the deal. But after all, I think what is fair is in the case where you negotiate with the others. You agree with the counterparty, and if you can incentivize others to work with you to basically advance your courses better than if you were doing it yourself, then that would be a great outcome. And I think, I've seen cases where basically you share fees up to 50%. It's, you say, oh yeah, we're in this together. We're like a partnership in doing this particular deal. Let's say, if we get the deal done, each of us will get 50%. In that case, everyone will be going out to say, yes, I'm going to go out and get this done, right? Because if we don't get it done, then 50% of zero is still zero. Right? Yeah. So
yeah,
partnerships is a great way. I mean, I say partnerships in a way that is loosely defined, not as, as in Australian taxation law that you don't want to enter into a partnership with people sometimes. But it's, it's so long as you have an arrangement agreement with others to work on deals together, that will be good. Yeah, obviously you want to enter into an arrangement, not just, verbally agree. It's always better to put it in writing, right?
Definitely. That's such great points there. And definitely need everything in writing. A lot of people, make that, challenge an issue. And I guess that comes down to that due diligence phase, right? Of, it's really extremely important in a lot of different things, but even especially, I guess, for, you know, the capital raising and exiting parts of businesses, right? Really understanding. So what's involved, you know, in that phase?
It's very, very involved. There are, you know, vendor due diligence. So on the sales side, you got to get your books together really, really well. And, you know, you got to have at least 3 years of financials. This is in the case of a mature business. And in some cases, when you're in a startup business, obviously you're not in place 3 years ago as yet, but, you know, so you won't have to have 3 years of financials. But people are always looking for a level of historical normality. You know, what at the time when you enter into the deal, you want to make sure that whatever valuation you were done based on, you know, whatever year's EBITDA is normalized, right? It basically means that, yes, that year you might have a revenue or EBITDA of $1 million, but there are, you know, if you have a business where the owners actually draw money out of the business as if it's their own personal account, then you really have to clean it up before you actually put it up for investment or for people to buy it, because no one really wants to buy a business with so much owners transactions, because, you know, owners transactions is typically really hard to get to the bottom of it. You know, they typically have a one line kind of thing in the accounts to, you know, to draw it out, but you have to back it all up as well. So as you know, one part of the due diligence is really just to normalize your accounts so that it takes out all these abnormal stuff, like if you have owners transactions, or if you have non-arm's length transactions, not even owners. You could have non-arm's length transactions with a related party, but the related party could, you know, it's not actually part of the transaction. Then in that case, you have to normalize it so that for future references to work out what the profitability is, your historical, you know, cost base or revenue base is normalized to what would be if there is an arm's length transaction. You know, if you were charging your own company a $10,000 rent when the actual market rent is $100,000, then you have to normalize it so that it's, you know, add that $90,000 onto the cost base. So your EBITDA would reduce in that case. And so those are the, you know, the type of detail you look out for, or the things that would otherwise be not normal, you know, just normalize it. And so we call it pro forma financials for the year that you're looking at, you know, and then you do, that's only part of the financial modeling, looking at what is the future outlook for this company. And obviously you look at all these historical documentation, you know, whether everything is set up properly, whether there's this huge checklist of 30, 40 items that each of these due diligence things have to go through. You know, what is the IP that the company owns, and who owns the IP? What's the potential, you know, sort of issues to do with that, if there is any legal battles that's happening, and, you know, what is the potential liability in that respect? What's the employee, you know, leave liabilities they might have, you know, you might have to pay when you acquire the business, if you know, got to get that right as well. And that, you know, any transactions, abnormal transactions, there's a whole list of things that you have to go through to do due diligence on both the buy and sell sides. Obviously, on the sell side, you want to make the business look as beautiful as it can, and you know, try to basically clean it up before you put it out, so that it's people can go through all the numbers and understand all the numbers. I had an instance where I was helping one of my clients, and they had a company that they're looking to acquire, and the other party actually had accounts that had different ending value and to beginning value on balance sheet. So, and you know, when you see things like that, you say, that looks strange. What is going on? And when the explanation is that they have changed accountants, that doesn't give you a lot of comfort, does it?
Not at all.
Yeah. So there's just, you know, lots of things that you have to look out for. Yeah. So, and on the buy side, if you were to buy a business, then you've got to make sure that all the forecasts, you know, they might have forecasts for a few $1 million here and there for future revenue. If they don't have contracts to back it up, or if they don't have, you know, things that kind of reasonable to you, then you know, when in normalizing, you just write it off. You just say, I don't believe this is true, and therefore you come up with a number. And sometimes the seller's number and the buyer's number could be vastly different. And then you negotiate, you know, you say, well, I don't believe this is true. I don't believe this and that. And if they can't explain, then you stick to your point. Yeah, and sometimes it's actually better for your clients, for, you know, in the case of buy side clients, it's actually better for them if they didn't buy a business that will lose some money.
Yeah.
You know. Yeah. So I think in one of the cases of my buy side clients, basically because of the advice I gave them, they didn't buy the particular business, but they were so impressed and they were so happy with the advice that they said, "Oh, find me more businesses like this. I want you to help me find more businesses." So not just, you know, on this particular assignment, it's like for future ones, just, you know. So when you deliver great advice for clients in their best interest, they would, you know, definitely they will give you more business, right?
Yeah, definitely.
Yeah.
So many awesome points there that you just raised. And there's a couple of things that I'm a bit curious about that maybe you can share that just popped out in my head was, like, I know, like with Australian tax law that I know more of is that, you know, if you want to not pay the company tax, right, of roughly 30%, then you make a slight loss in the business, right? Now, you know, a simple way to do that is to pay yourself like your wage or, you know, director fees and things like that, that you can do. And that way, you know, whatever that amount is, then you can put it into a loss. If it's best for tax purposes, right? That'll depend on everyone's situation. So then you could overinflate the wage, right? Just for tax purposes. So then would you then take that out in that EBITDA calculation? Just say, I'm just putting this as my wage and then put that out. Is that how it would work, or?
Well, you would look at the market rate, you know, whether if you have inflated it, then you would actually reduce that inflation. And, you know, you look at I guess, pay more attention to the directors or the owners in terms of how much money they're drawing out of the business. This is what I was talking about earlier, basically the owners' transactions. So this could be one of the owners' transactions. But one of the important points is that you can't, I always say to business owners, you can't have, have your cake and eat it too. You can't manage your expenses so that you pay minimum tax, but then you want to make that a higher EBITDA in the case when you decide to sell, because you have your accounting books, but the buyer would want to see your textbook as well. So it is if you said in the text that this is how much I'm paying, then that is how much you're paying. So yes, you do normalization on the expenses, but to a certain level. You can't say, I'm going to my company has been earning zero for tax, but in fact it's actually profitable. But it doesn't work that way.
Yeah, no,
Yeah.
that's a good point. The other one that popped out to me that I see people do, you mentioned IP, and which is obviously important for businesses, because then there's more certainty in the products and whatever else that they're selling. So what I see sometimes, what people do, I don't know if you've had experience in this, is some people have IP registered within the business. Some people have like a different entity where IP is registered. So do you have any experience in that on what the pros and cons are of doing that?
Yeah, investors always want to invest in the business with the IP registered to its name. So that is pretty much a given. But you can always work it out so that it is pretty much, it can be assigned on investment. For example, if it's registered in the holding company, you can say, well, at the time of transaction, we'll assign all the IP to the subsidiary where you're putting all the money in. That's one potential way of getting the IP in there. Or the other way is basically have a license, sign up a license agreement for forever or for as long as law allows, and then with a peppercorn license fee or whatever license fee that the investor or the buyer is happy to pay. So that's sort of subject to negotiation then. Yeah, I have seen it done in both cases where people have the IP registered to one company and say that I want the investment in another company, which you have some investors that are vehemently against that kind of thing. Then you lose that potential investor by basically structuring it that way. But in other cases, investors are not, they can work around it. So it's not always a deal killer or deal breaker. I guess that's what I'm saying. Yeah.
Yeah. Is there any for like risk or anything like that, for like a reason why you would have it in a separate entity rather than the business that you're trading in?
That's possible in that the IP may have developed under a different name. When like businesses grow, ideas change, and maybe one day entrepreneurs are great at developing new ideas, right? So they could be developing one idea in one business and thinking this is going to be the one for the future, but a couple of years later, they said, "Oh, there will be a better idea. I'm going to use this." So it's history. It can be history as well. But if you can manage it, it's always better to actually make it clean on the transaction or before transaction, and tell the investors that it's clean this way. Yeah.
Yeah.
Obviously, the risk is that the transfer of license or the license or the transfer of IP or the license itself is not valid, and therefore whoever invests in the company that the license is not in the name for, they have they have the risk that they may not have what they need for business. But obviously any good business buyer or advisor would say, make sure that lawyers make sure that all the clauses are in place and all the the right documentation is in place, so that you have what you need to run the business, and you pay for only the minimum that you need to pay for it.
Yeah, definitely. So very important. That's why having, advisors, accountants, lawyers, and people like yourself, in those transactions, because there's so many different variables depending on what type of deal it is that, you don't want to miss something that, hurts you. So, and then I guess if you're looking at like exiting a business, right? Who should, who should you get involved? And I guess what things should you do to get the the highest amount and the best terms specifically? Like, are there certain people that you think and various stages that would be good to get involved there?
Yeah, it's another depends question as well, because businesses exit at all stages of their life cycle. Some businesses exit at very early stage once they've got an MVP, or once they started, it's even like very early stage on, and people exit businesses for different reasons as well. Some of them are to do with life situations where, one of the owners died or whatever, then you just have to do it, right? Exit it that way. But let's say if it's under the normal circumstances where someone's decided that they just want to exit the business and they've been in the business for a while, it's been operating for a while. So in that case, you sort of try to look for a really reputable advisor to help you from a financial perspective, from a legal perspective, tax and all of those things. And also basically when they do that, they will look, the advisor will look, okay, this is, let's say if it's a manufacturing business, and they will say, yes, who are the potential buyers? You could have a trade sale to somebody else that's in the supply chain, or someone, even a competitor. Competitors buy each other out all the time because they basically buy another piece of the same business. That is actually a really good thing where it's consolidation, right? You got a business A, a business B, so 1 + 2 = 4. That's when you have, if two businesses have synergies, then you can actually get better outcomes for the sale. That's where the advisor will come in and say, well, I believe these are the potential acquirers of your business. And typically there's your typical trade sale, your typical private equity sale, or VC, depending on the stage of development. So these kind of professional investors or professional business buyers, they would look at the business and say, am I going to be able to grow the business and exit it again in the next 5-7 years, depending on their own horizon as well. And the other one is basically exit by listing. If you have a business that is a reasonable size and putting it on the ASX or NSX, you'll be able to exit it, and you don't have to exit it 100%. You can exit it a certain percentage, and make it a publicly listed company. And in that case, obviously you'll need to look for IPO brokers who will help you do the IPOs. And there's reverse takeovers as well for IPOs, so you don't have to do a fresh IPO. Because fresh IPO, you have to demonstrate a certain history, and there's net asset thresholds, and also profit thresholds as well. But if you do go it via a reverse takeover, that means there is a listed company already, and you just you merge your company into that listed company. In that case, the listed company has already been operating for a while, and they're kind of dormant at the time when your business goes into it. Then there are sort of time frames are potentially shorter, but you got to find the right RTO target as well. And that situation can take some time. There are a list of companies on the stock exchange that are pretty much dormant, that very low share price, but each one of them have a shareholder list of maybe a few thousand people. So you have to make sure that you're sort of RTO back into a company that has the same type of, not necessarily the same business, because you can RTO into a different line of business nowadays, but the existing shareholders has to be aligned in terms of thinking for future as well. There's a lot of things to consider in that case as well. So, I mean, I guess IPO and RTO are sort of along the same lines, where you're just basically going from a private company into a public company, publicly listed company.
Yeah, awesome. Some amazing points there, Cissy, and it shows just like there's so many different complexities and variations, which is why obviously someone like you is really needed to understand what's the best strategy, and then what do you need to do beforehand as well, to make sure that you get the best outcome. And I guess more on that, you also have a podcast yourself called, the Capital Raising Show. So yeah, please let everyone know more about it.
Sure. Yes, I started it a few months back, thinking that I am raising capital for a number of companies, but at the same time, when I'm raising capital, I discovered that there are various, in Australia, there's definitely a kind of investor bases are quite different for angel investors versus VC investors versus family office or private equity investors. So different businesses will call for different type of investors, and so I thought, how about if I do a show that basically I sort of interview entrepreneurs who's raised capital, and I've sort of set it as at least seed level of capital. And or investors who's serial investors in businesses as well, and I interview them for what they are doing in terms of, or what they did, what their experience were in a number of, maybe they've had a couple of capital raises, for example, maybe they've invested a number of businesses, and so I asked them what's their experience, or what made them invest, or what made their investors invest in their business, and what are the learnings that they had, and what's the pitfall that they want others to avoid, so the listeners will be able to actually get some benefit out of it, and hear real life experiences of people. It's not a textbook approach. It's similar to what you're doing. I'm trying to kind of limit it to 30 minutes, but I find that every time, people talk longer, as I'm doing right now, I'm talking longer. Because it's so easy to just basically extend, because whoever you're interviewing, they tend to be people who's experienced and who's already done it, and when you talk about their experiences, then there's just so much wealth that you can learn from it. And I'm not as quick as you. I think I'm up to episode 11. But I haven't actually uploaded all the episodes on YouTube yet. I think I'm up to episode 9 on YouTube. So yeah.
Yeah, awesome. Now you're getting some really awesome guests on there. A couple that I know, and I definitely implore anybody that's looking at investing or capital raising to definitely check it out, or just to gain that knowledge. So a really awesome show. We met through our networks and have a mutual coach, and you have a wealth of knowledge and connections, and are happy to help people in any complex business challenge. Your business experience and CPA background gives you the perfect platform to help people in need with your expertise. So I'm very grateful that we connected, and I look forward to working with you in the future as well.
No, thank you very much. I really appreciate you reaching out to me. And I'm happy that I could provide some value to your podcast listeners as well. I hope it's not too boring, a show.
Not at all. There's something for everybody, Cissy, and this is some really, a lot of people don't like the numbers necessarily as much, but these things and the due diligence and all that is the most important in there, because otherwise you're just pie in the sky, but this is not how you really run a business. So really important stuff. So I think everyone's got a lot of value from today. So thank you very much for your time today, Cissy. I'm sure many people have greatly benefited from your valuable wisdom. So how can people find you and get in contact with you?
Grow and Sell Your Biz. So www.growandsellyourbiz.com. That's my website. And you can look me up. My name is Cissy Ma. And look me up for on LinkedIn, on YouTube. The capital raising show is on YouTube, and it's also on mini Netflix. So yeah.
Yeah, awesome. All right. Well, thank you everyone for watching and listening to this show where we talk about everything on business growth. You can find me on Facebook, LinkedIn, and Instagram as Athin Cassiotis, or visit my website, athincassiotis.com. I completely agree with you, or do I? The only way we know is if you tune in next time. Until next time, remember that our business grows when we learn skills and take action using them in spite of fear. Have a great day.